As we've been doing every year since 1968, Barron's convened our annual panel of investing experts this week to look at the year ahead and share their investment strategies. It's the Barron's cover story this week. Delphi Management founder and renowned value investor Scott Black was a part of that discussion, and he joins us now to talk about where he sees opportunities in 2025. Scott, great catching up with you this week. Thanks for joining us today.
Well, it's nice of you to invite me, Jack. Thank you.
Sure thing. So before we get to your stock picks, give us a quick big picture view. You think the economy is pretty strong, but at about 23 times this year's earnings, the market is a bit expensive for your tastes.
It is. You know, it's interesting. If you look at real GDP growth for the coming years, probably 2 to 2.5%. If you look at the PCE and CPI core, somewhere between 2.4, 2.5. So you get nominal GDP of 5%. That's healthy. It's not a runaway freight train, but it's good. And you saw the employment numbers for December were excellent. We actually created 2.2 million more jobs for the whole year. So there's a lot to be said for the strength of the U.S. economy, especially when you compare it to what's going on in the Eurozone or even places in the Far East. We're doing much better than most other economies in the world.
Yeah, and, Scott, you weren't the only one that was feeling a little nervous about this market. I mean, it seemed to be the way that most panelists felt, that the market was just a little too expensive, priced a little too much to perfection. I think there were only one or two of you who actually were feeling pretty bullish about it, which I guess shouldn't be a surprise given that you are value investors, or at least most of you are. But as a value investor, I also shouldn't be surprised that you had one pick that was a bank. I'm familiar with things like JP Morgan and Citigroup, but not with Bancorp. Can you tell us about that?
Look, this is a little bank out in New Jersey. Market cap's around $400 million. They've been consistently doing 16, 18% on book. Since the COVID crisis, most regional banks are doing 8 and 10. Their efficiency ratio is down at 44%. And based on this coming year's earnings, which will be up in like mid double digits, they'll do about $465. It's an 8.6 multiple. Going to do about 15% on book and 1.77% return on assets. They're fully reserved against non-performing assets in OREO, about 1.7 times, so you have a margin of safety. The only knock I can see on the company, it won't get a big multiple because the bulk of the portfolio is commercial real estate. But they're not doing Ma and Pa. They're doing people who own Sheratons and Hiltons and Marriotts and people like 7-Eleven. So it's concentrated in a lot of bigger credits. But the bottom line is, they are slightly liability sensitive. So if rates back up a little bit, it knocks a little bit off their net income overall. But it's a well-run bank. They have 21 branches. It's basically northern New Jersey through central New Jersey, which is a wealthy area. And I think, it's reasonable at an 8+ multiple.
Hi, Scott. It's Alyssa Corum here from Investors Business Daily. Now, I really like looking at stocks from a fundamental and technical perspective. And when it comes to your pick, SS&C, which provides software and services to hedge fund and private equity firms, I really like how it's showing stability in a volatile market. And it's up about 20% since last July. So what are you seeing in SS&C from a fundamental perspective?
Well, we've owned the stock for a long time. We're actually customers of theirs. Our trading platform, our valuation platforms are all SS&C. This is a company that basically manages the top line growth. It's 5 to 6%, but they got great operating leverage. On each incremental revenue dollar, they make 45 to 50 cents. So they can keep growing the earnings 10 to 12% a year. They've only had one break in earnings per share in their record. I think you have to go back to 2017. They've had pretty much a straight up record. The company earns about 19, 20% on book. By its own design, they have a net debt equity ratio of 0.9. It's because they generate a lot of cash, but they buy back stock. So we figure this year, they'll do about 580, which puts it at a 12.9 multiple. But we have to be honest, they have 84 cents in stock-based comp. If you take that out, that pushes the multiple closer to 14.9 times. But for a steady company with double-digit growth, generates more free cash flow than it earns, I think it's a very decent play at a 14.9 multiple.
And Scott, this is Al Root. One of the ones I was interested in was an old Honeywell spinout. Some of those companies haven't done very well. You recommend Advansix, makes nylon. Years ago, I wasn't so sure about it, but that was a long time ago. What are you seeing now?
Well, I see that the earnings have already turned. That's the big thing. You want to have a catalyst. You just don't want to buy something that's cheap. It's dead money. They've had 2 successive up quarters. The earnings are taking off at this point. They have good demand for both nylon 6, the ammonium sulfate, which is a type of a fertilizer, and they do what we would call intermediate chemicals. So I have them earning a little over $4 this year. It's a 6.5 PE. If you take out, again, the stock-based comp of 24 cents, it's a 6.9 PE. I mean, it's 1/3 of the market multiple. They have a clean balance sheet. The net debt equity is about 0.26. The return on equity pro forma is about 14%. The return on total capital is 12%. And even though they have a big CapEx spending this year of $150 million, they're still going to generate $20 to $25 million in free cash. If you went back in the 10K and you looked at previous years, they consistently generate free cash flow, which is very important with the Delphi strategy. And if you don't ring the cash register, it's not a good business.
Scott, nobody knows their portfolio better than you do. I think you could teach the CEOs a thing or two. Thanks so much for sharing these picks. You can see one more pick from Scott Black in this week's edition.